Ladies and gentlemen, hello and welcome, coming to you once again, not quite live, from One Take Studios, where today we are talking about math models in banking, which could be a huge topic, but we're going to go with a very specific focus today, and that focus is going to be on loans. I would like to borrow money. How does that work, or how might that work at least? The concept of taking out a loan is that you are renting money. So just like you might rent an apartment, you get the use of the apartment and you pay for it. Well, that's what a loan is. You get the use of the money, but you have to pay for it as well. There are some words that you should be familiar with. The first one is principal. This is not somebody in charge at your school. This is the amount of money that you are borrowing for your loan. So essentially it's like the starting amount, the focus amount to begin with. Interest versus interest rate. We want to be careful here. Interest itself is money, cash, dollars, cents. This is the cost it's going to be in order to borrow this money. This essentially is our rent. The interest rate, however, if you see those two words together, is referring specifically to a percent, and that's what we are using to calculate the interest. Usually what you are seeing is a yearly rate, so if you happen to see the letters APR, that's annual percentage rate, so often a yearly rate. Okie dokie. There are there we go. Right there. That's where I want to stop. There are two different types of formulas I want to look at today. Technically three, but basically two. And the first is simple interest. All right, so a star next to this simple interest. I'm not sure that this is actually used by a whole lot of banks. However, it's a place to start. We are going to calculate the interest. Notice interest, that's this guy right here, based on the entire principal, and we're going to use that for the entire length of the loan. So even if you pay down some of it or whatever, all of this is still going to be based on the original amount of money. The formula looks like this. Whoops, there we go. The formula looks like this. I equals PRT. Capital I is interest. Capital P is principal. The lowercase r, that is our rate, our interest rate. And then T is time. T is going to be time in years if your rate is in years. If for some reason your rate is in some other thing, then the time might change to go with it, but typically you're looking at years for this thing. Now notice this only calculates interest. So if I run a calculation with this formula, I don't get a good feel of how much I have to pay back. I have a good feel of how much it's going to cost me to take out the loan. So there is a secondary formula kind of attached to this here, and that is a mature value. This thing reaches maturity when we actually combine the principal and the interest, which should be logical if you think about it. Okay, this is, what do I have to pay back total? Well, I have to pay back the amount of money that I borrowed and the interest. So this is really basic, tying these two things together. This gets us a good feel for the total amount of money that's going to be owed. Okay, let's look at this in terms of an example for a moment. Yes, there we go. All right, so here's a problem. We're going to buy a $20,000 car, which many people think $20,000 is not a lot of money. Well, let's see what you think when we're done. Maybe you'll agree, maybe you'll disagree. We're going to use simple interest. Sometimes I've seen textbooks refer to it as being add-on interest, so that's another way to say simple interest. And we're going to have a down payment of $2,000 on our car. So yeah, that's 10%. We're going to say we have a 4% annual interest rate, and we're going to take out this loan for 3 years. What does this mean that I can do? Notice I left a ton of space here to work because there's lots of questions that I can answer based on this. So, all right, things that we might need to know. What is the principal for this? Again, principal is uppercase P, usually. Well, that's the money borrowed. Am I borrowing $20,000? Not really, because I have a down payment. So I'm removing $2,000 from the $20,000, and the loan that I'm taking out is actually only for $18,000. So I need an $18,000 loan right now. That's going to be the amount of my loan, my principal. So that's the money that I'm trying to rent, and of course then there's going to be a charge in order to do that. So if I go back to my interest formula, which is over here, I say I can find out how much interest, so this is what it's going to cost me, essentially, to take out this loan, is going to be principal, so $18,000 times rate. Rate is 4%. Please use 0.04. Again, you must use the decimal form of percents when you're doing calculations. And that's per year, and we have this for 3 years. All right. Calculator, 18,000 times 4% times 3 years. That's going to be, did I type it in correctly? I think I did. that is going to be $2,160. And that right there, that is just the interest. Keep in mind that these are both going to be money. We took out a loan for $18,000, and it's going to cost us $2,160 in interest in order to take out that loan. Now, think about how much is this car going to actually cost me? Total cost for the car. Is your brain in the on position? Okay, make sure that you're thinking about this. What did I pay for this car? Because again, I said there's a whole bunch of questions that we can answer based on this. I paid the $2,000 down. Ooh, did you forget about that already? And then I paid the $18,000 for the loan. And then I paid the, whoops, that should be a plus sign. And then I paid the $2,160 for interest. So grand total, what did this cost me? Do I have the right number of zeros? I think I do. Although I should be able to do this one in my head. Silly me. The car grand total cost me $22,160. Despite the fact that the car was $20,000, this is how much I end up paying. Now, are there a whole bunch of things that I did not take into account here? Yes. Tax, title, license, all that fun stuff. We are looking at the basics on how loans might work today. So we're just going to say, hey, $20,000 covers everything. That's convenient. All right, so that would be total cost of everything. Well, what if I wanted to figure out a monthly payment? Can I afford to pay this every month? Maybe, maybe not. How would we piece this together? Well, monthly payment. What would go into this? A down payment is the money that I pay in advance at the very beginning. So I don't have to pay the $2,000 back. I do have to pay back the $18,000 and the interest. By the way, interest, also known as finance charge sometimes. So if you see the words finance charge, that is the same thing as interest. So we're going to have to pay back the $18,000. That was the loan. That was the principal. We're going to have to pay back the interest, $2,160. And we're going to divide that up over, well, let's think about this. This is going to be 3 years, but we don't make payments once a year usually. We make payments every month. So that means that we've got a grand total of 36 payments to make, right? All right, so again, let's do some calculations with that. I'm going to do parentheses 18,000, 2, 3, there we go, plus 2160, and we are dividing that by 36. Grand total is $560 a month. So, ladies and gents, think about that. $20,000 car, do you still consider that to be cheap? Because that payment is $560 a month. And that's, for some people, myself included, that can be a lot of money. So, what's happened with car prices? Well, quite frankly, they've gone up and up and up. And since they keep pricing people out of cars, they've been extending this. It used to be that all loans for cars were 3 years. And then all of a sudden they were 4 years, and then 5 years, and 6, and 7. So basically they are willing to spread out the payments as long as you need to be able to pay for your car. Is this a good thing? Probably not. All right, so all different questions that we can answer based on those formulas. So it's not just using the formulas, it's also using your brain to piece together what hopefully makes sense. All right, so next up. We also have this guy right here, all right? We have compound interest, compound interest. This is a lot more popular than simple interest as far as its use goes. We are calculating your interest several times throughout the year, and then you end up paying interest on your interest. So think about what that means. Before, we were only paying interest on the amount of money you started with, the principal. Now they're saying, well, first I'm going to apply the interest rate to the principal, and I'm going to add that in, and then I'm going to charge interest on that, which will be a little bit more money, and then I'll charge interest on the previous interest, and that'll be a little bit more money. It's a little crazy, and it usually works out in the favor of the bank, which is why this is preferred. All right, ladies and gents, right here. Do you have this formula? This is going to be my second star for the day right here, next to compound interest. So simple interest, compound interest, the two biggest things today. What do you notice about this formula? We've identified most of the variables already, but this one does not equal I. Ooh, fuzzy, there we go. This does not equal, this equals M. In other words, we can leave out the extra step that we had over here, we're not going to have to go ahead and add this together because this formula already does this. This formula calculates the interest and adds it into the principal, so you get the grand total of everything you owe by the time that you're done running it. All right, so things to think about there. So we actually know what all the variables mean then, except for the n, and we're going to say where n is the number of times compounded per year, which again frequently is monthly, but you could have quarterly interest, yearly, semi-yearly, bi-yearly, daily, your choice. But again, frequently, n is going to be 12 because monthly would be 12 times in a year. That's how often the interest would be applied. Now, good news, bad news. I want to run this with the same example as before. However, so get this back over here. However, let's say instead of using simple interest on this, let's say that we're going to be compounding it monthly instead. So we're going to set this up, find our mature value is equal to the principal. So again, if we have the $20,000 car and we did $2,000 down, that means that $18,000 is the amount of our loan, that's our principal, times 1. Yes, that is a number 1. That is always 1. Why? Because we are going to pay 100% of the $18,000 plus more. So this is showing us that we are paying all of the original amount plus additional interest. So again, it's kind of like that's where we're seeing this piece come in right here. We're adding them together. Now, here's the good news. We can do this with 4% interest, but keep in mind the interest rate is yearly, and we're doing interest monthly at the moment. So you don't get charged 4% interest every month. That's the good news. We're actually going to divide the 4% by 12. So you get one sliver of the interest every month, 1/12 specifically of the interest every month, so that over the course of the entire year, you end up having paid 4%. And then our exponent here, this is going to be n times t, n times t. So that's something that we actually saw again over here for a moment. We're doing this 12 times a year for 3 years, so we can see that 36 that we saw over here previously as well. All right, so we grab the calculator and we say, all right, how much difference does this really make? 18,000, that is not an 8, times, parentheses, 1 plus 0.04 divided by 12, close parentheses, to the, and I'm just going to call that 36, to the 36th power. And we get this amount right here. So this is going to be 290. I'm going to check my answer. Yeah, see, sometimes they rounded that. That was 89 cents. I'm going to call it 89 cents. All right. Is that more or less than running simple? Think about that. Think about that. Did we ever just add the loan and the interest over here? We threw the $2,000 in as well, right? Because we asked what the total cost would be. So think about that. Let's throw the $2,000 into this as well. On simple interest, we were paying a grand total of $22,160. But if it's compound interest and we throw in that $2,000 down payment, we're paying $22,290.89. So because the interest is applied a little bit more often, we end up paying a little bit more money. Okie dokie. All right, fascinating stuff here, folks. One last thing that I'm just going to put in as a mention. We have also something called continuous compounding, and quite frankly, I've never heard of where exactly it's used, so if you use continuous compounding, please contact me. I'd like to hear about it. All right, so this is going to be if we're compounding not every month, not every day, hour, minute, second, but continuous compounding. We then use E as the base instead. So I call this the PERT formula. We still see the principal as P, but we would actually use E, that's the number 2.718 approximately, to the RT power. And that's another formula that is available to you. All right, so think this through. Try to put yourself in the position of either the borrower or the lender and see how you can piece this together so that you don't end up paying more than you have to. That's honestly, again, with money, pay attention. Nobody's going to take care of your money better than you, so know what's going on, all right? Thanks. Have fun.